What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances. What's up, everyone? Welcome back to another episode of the Long Game Podcast. I'm here with my co-host, Thomas Kopelman. And today's discussion is something that I'm really excited about because it's something that I was confused about for a really long time. And today we're going to talk about asset allocation. So you're probably thinking, like, what is asset allocation? So I want to break down, before we even dive into this topic, just a really simple breakdown of what is asset allocation. And this is the same way that I do it for the clients that we work with. The way I think about asset allocation is simply this: how much do we want to have in our growth bucket and how much do we want to have in our defensive bucket? And really, the reality is, like, the more that we have in our growth bucket versus the more that we have in our defensive bucket is really going to determine a lot of what our return is. And I think one of the things that Thomas and I are really excited to talk about and educate you guys on today is not just what should be in the growth bucket versus what should be in the defensive bucket, but also talking about, like, we have an election coming up. The US market has outperformed for a really long period of time. So why on earth would I potentially invest in international stocks? So with that, Thomas, excited for the conversation today.
Yeah, me too. And I think it might even be helpful to take even a further step back on asset allocation. So I think, like, me as a financial planner, I view there's like two parts of this. I think one is just like total assets you own, right? So this is outside and inside your investment portfolio. So we might have some real estate exposure. I mean, I'm not really somebody to like count vehicles unless you have like a collector vehicle part of your net worth. You have cash, you have bonds, you have stocks, maybe some other investment properties, maybe some private investments, maybe the business you own, et cetera. Like, that is your full investment portfolio. And I think at times it's really hard to view, like, I want this percent in this class, right? Because, like, maybe early on you bought a home, the home appreciated a bunch, and right now real estate's 40% of your portfolio, even though it's not really part of your investment portfolio. Well, hey, that might be really out of whack. And so for me, I typically view clients of what's your investment portfolio is one part of it. And then we'll look externally and say, hey, you own some real estate and some rental properties. Like, maybe we shouldn't be adding exposure to real estate in your portfolio. But I think there's people like, you're going to have cash goals, right? So maybe you have a lot of cash on hand right now because you're saving for a down payment of a house, or maybe your house is appreciated, or maybe you're really early on, but you just started your business and all of your net worth is tied in your business. So I think viewing all of it holistically is one thing, but then I also want to view just the investment portfolio in one part, right? Because if you're the person that has 30,000 invested, but 470,000 of equity in your house, and you look at all of that together, it's going to be really hard to make portfolio decisions when it's mixed. So I always segment that investment portfolio and go from there to make decisions. And so, like, the asset classes we really want to think about inside of investment portfolio is first international and US, right? So that's the easiest beginning starting point. But then underneath those, you might want to segment it out more. For us, we look at US large cap, US small cap, US mid cap. We look at US real estate. We look at US bonds. In reality, that's probably the most of it. And then international, we really just go between international, emerging markets, which emerging markets are just like smaller countries that are really kind of emerging and developing, and then international bonds. Some people look at growth versus value. Some people look at momentum. There's a bunch of ways and beliefs that you can go into it, but that's kind of the breakdown of what your asset allocation mix can be.
Yeah, I think one point you made there that I want to reiterate back for people listening. You and I both work with a lot of business owners, and time again, I'll see a business owner that comes to us and 90% of their net worth is in their business, right? Like, it's their highest appreciating asset and it's completely normal. It is really important that you're tying in all the investments you have into your total asset allocation and not just thinking about just your public market stock portfolio, right? Like, you need to be thinking about the real estate, but for business owners, like, this business and how you think about it always ties back to, like, how we're thinking about the other investments we're going to be making outside of it. So I think that's a really important point you made there, Thomas.
I think that is really important that you hit on that too, because I think the way that you invest is based on, obviously we talk about risk capacity and we talk about risk tolerance, but it's also like, what do you have going on in your life, right? The person you talked about is 90% of their net worth in their business. Well, here's the good of it, right? Like you own a business because you think you're going to get outsized returns. If you're really not going to get outsized returns relative to the market, you're putting a lot of risk into having a business, right? So you say, hey, my business is growing well. We're growing at 40% a year. This is going to be something I'm hopefully going to sell long term. Well, because of that, the way that you invest is very different than somebody who's a W-2 earner. They have security in their job, right? They might need or want to take more risk in their investment portfolio than you, because your risk play of your portfolio is your business. External to that, you might not need to be seeking above average returns, right? You might want to have a lot more diversified of a portfolio because of the situation you're in. The other situation that might make sense for is, I work with some people who have a ton of real estate exposure. So yes, that is a little defensive in what certain people say, but when you own 5 properties as most of your net worth, you do have some risk, right? I have a client right now, they own a condo that they rent out in California. HOA is having a problem because basically the building is like slowly collapsing, right? And so they can't get out of the business, or they can't get out of the rental right now. If they even could sell it, they had an opportunity to, they would have lost 50% of the value of it. And so even though we don't think about real estate, it can be really risky. So again, in that, you might externally say very little real estate, maybe a little bit more conservative of a portfolio than somebody that doesn't have those type of risks.
Yeah. What I think would be helpful as we transition into this conversation for you to be thinking about it in your own situation. Thomas, what is the starting point for you for the clients that come in? Maybe they have a bunch of real estate exposure, maybe they have a bunch of exposure in their business. What are the first questions, thoughts, processes that you guys are going through to try to help them to start to figure out what is that total asset allocation and what should it potentially look like?
Yeah, it's interesting. I think we have a general belief that you should have exposure to US, to international, to small cap, to mid cap, in emerging markets, to real estate, right? And so then we'll look at their portfolio and say, hey, you right now are 90% US equities, right? And maybe they're in a taxable account, it's grown. We don't really have good opportunities to sell without taxes. Okay, great. Well, now we know that with the rest of your portfolio, we really do need to get you to a lot higher of international exposure, small cap, et cetera. How can we do that, right? Can we do that through your tax advantage accounts? And if not, then we need to do it through future contributions. But I do think the first part is getting on the same page with the client and deciding, or the person, anybody, this is really what you do. You need to get on the same page of what your beliefs are. I have my beliefs on how I allocate to international and why, but a lot of people don't have that belief. And so I think, it's easy to be like, well, why aren't they listening to me? Why don't we do it? But we all know the best investment portfolio is the one that somebody can stick with for 40 years, right? So if they choose one portfolio versus the other, and that might have lower returns, but they're able to hold on, is way better than, hey, I convinced them to put 25% international. International has been down for 3 years. They sell it all. And, they're always making changes because it's not aligned with what they want. So there's a few ways that I talk about this. I think one is I show a lot of data on US versus international exposure. So I think if you talk to people, the average thing that most people say is, well, why would I allocate to international? But most of the people you and I are talking to have only been around investing for this period of time where US significantly outperformed, right? So if we look back from like 2009 to today, basically US has drastically outperformed. 2023 international did pretty well. India, Japan, some other countries have done really well. But then if we look before that and we go back from 2001 to 2009, that is when international did better. And then we go back and we say, okay, from that period of time till 1995, US did better. And then we have about 3 years of international. And then we go back and we have like 7 years of US. And then we go and we have about 7 years of international. So typically, based on history, US and international switch off outperforming. And so I look at all these people who say, well, why would I go to international? US has outperformed for the last 13 years. To me, that's almost more of a reason to allocate to international, right? If we look back in all of the history, it always switches off. And now we're at the longest period of time. People say US markets are overvalued. People say international are undervalued. I'm not here to predict and say international is going to be better or US is going to be better. The goal here is that when you have a diversified portfolio, you can expect similar returns, but less of the ups and downs, right? And I think that's really the goal, and where I start with and show this of here's why we think of the allocation. But the way that I do this is basically the size of the market. And that's kind of the best way I found to do it. Because if you do anything else, you're basically taking a bet. If you have 50-50 US international, right, you're taking a bet on international that's going to outperform. If you have like 100% US, you're taking a bet US is going to outperform. And so generally it ends up being like, 24 to 30% of international plus emerging markets, where your portfolio ends up being anywhere from 60-40 to potentially 70-30.
Yeah. You hit the nail on the head when you said the best portfolio is the one that you can stick with. And I think if you hear nothing else, like hear that. Now, like I'm not saying like every portfolio is the same, and if you just stick with it for 30 years, it's going to work out. You need to make sure that you have good fundamentals in place. But I think time and time again, I see people, they make changes because maybe somebody told them that they should, and then they aren't willing to stick with it for the long term. A couple things that come to mind for me is it is a lot harder to invest in real life than it is looking at a chart. I'll never forget the first time I went into an advisor's office and he had that chart. And people out there that are listening have probably seen this. It's in a certain financial advisor, big company's office. And it starts in like 1919 and then it goes to like the current year. And it's just this trending line up. And you're like, oh, so you just tell me like I put the money in the future I have more money. And the reality is like all those little blips along the way were times where people were panicking. It felt different. I wanted to sell, et cetera, et cetera. So number one, you need to be able to stick with whatever asset allocation you have. And then number two, just understand that real life is different than the graph. The 10-year chart that shows that international has underperformed the US for these past 10 years, I can assure you in 50 years, it's going to look like this little blip on the radar. And you're like, yep, that was the time when you wanted to make sure you still had exposure to international. And right now it doesn't feel like that. So I just encourage everybody, like, understand that this is different in real life. Like the days go by a lot slower than when the chart is 1 inch long, and that's 10 years.
I mean, I couldn't agree more. And the statistic is that over the last 50 years, let me find this. Over the last 50 years, international has performed 40% of the time over trailing 10-year periods or 10-year rolling time periods, right? So like that's a pretty good period of time. And there's a lot of good data to show why exposure to international is important. But I'm curious for you, like, what is, maybe off the top of your head, kind of what is the breakdown of the portfolios you use? Because I know for us, I mean, we still have a large exposure to US large cap. I mean, we still have about 42% ish to US large cap, about 15 to mid cap, about 6 to small cap, 24 to international, about 6 to emerging markets, and then about 3% to real estate. And obviously I didn't say any bonds, like that's our all equity portfolio. There's a lot of different ways to do this. I mean, you could satisfy this with a couple funds. You could satisfy it with, 8 to 10 funds, really depending on what you want to do. And then we have a bond portfolio that those all shrink accordingly based on if there's going to be 10% bonds or 20% bonds or 30% bonds. But when we're working with a lot of accumulators and a lot of our clients that are high risk, have high risk tolerance, they own crypto, they do a bunch of other things. A lot of them are 0 to 10% bonds.
Yeah, I would say we're really similar in terms of like the total allocation. We're generally shooting for somewhere between 20 to 30% international. And I'll preface this by saying a lot of the clients that have come to us, maybe we're working with an advisor previously, so there might be existing positions there that are intertaxable accounts. So we're really navigating one around that with pushing in maybe new money in the future to try to get an allocation to where we want it to. And then, much like you, Thomas, like there's still a heavy exposure to large cap US companies. And the reality for that is pretty simple. Like they have a lot less volatility than as you continue to move down. We do look to tilt portfolios a little bit towards some asset classes that I think have a higher expected rate of return in the future, things like small cap, things like value stocks. But again, a client has to be comfortable with that. I think our job as the advisor is to make sure that we educate our clients on the different options they have. My job is not to tell somebody that this is the only way to invest. It's to provide a couple options that are really good foundational options and then determine which one of these ones will we be comfortable with sticking with forever. I can remember telling a client, he was asking, well, out of these two options, which one would you feel like is best for us? And I said, like, if it was me, here's what I would do. But the only thing I'm going to tell you is whichever one of these ones we pick, we're not changing it. And I remember him smiling, and he still brings it up in meetings today. But that's how I feel. Like, if we're going to pick a certain investment portfolio, whether it's more aggressive, less aggressive, like we can make slight tweaks and changes along the way. but the fundamentals of it need to stay the same, because the minute you start changing the fundamentals, like time and time again, the market changes and you're like, well, you know what? I want to switch all to large growth because it's been doing really well in the US, and then international outperforms. So you got to stick with whatever allocation you're looking to do in the beginning.
Yeah, because it is easy to look at what did well last year and then make that allocation change. And you're like, oh man, I made the wrong choice. Now I switched out something that did well. Now I need to go back. And really, it's get this asset allocation, have it pretty nailed down, and then have rebalance plans. Right? Maybe it's quarterly, maybe it's semi-annually, maybe it's yearly, maybe it's even more, depending on who you are. And you say, here's the allocations that I want. At that period of time, you look and say, hey, this went up, this went down. For most accumulators, you can rebalance through new money, which is oftentimes the best way to do it outside of tax advantage accounts. So you don't have to be paying any taxes, obviously. But I do think it is important to make sure that you do check in on it, because eventually things are going to run wild and it's going to be way out of whack compared to what you want.
Yeah. One other thing that I want to talk about with asset allocation that I think is relevant in 2024 is, you and I probably both see this a lot. Somebody comes to you and they say, like, why shouldn't I just invest in the S&P 500? Right? The S&P 500 has done really, really well for the past decade plus. And the S&P 500 is essentially all large growth. So you're essentially taking all the different asset classes that we talked about, large cap, small cap, mid cap, international, emerging, and saying, I'm going to put all my chips into one basket. And outside of that, like a specific area in one basket. And what I would tell everybody is, like, again, our job is to try to educate people on it. And Thomas, I'd be curious to hear your stance on this, because we've had some people come to us and maybe they own QQQ, which is a position that is very heavy in large growth, similar to the S&P 500, but even tilted more towards those growth techie type positions. And helping to educate them on, just because the returns have been really good for the past decade plus does not mean the next decade is going to continue to look like that. And we're not here predicting what market returns are going to be. I would encourage anybody, if their advisor's predicting what's going to happen in the market, that is a red flag. But at the same time, we want to use all the data that we have and make the best educated decision we can moving forward.
Yeah, it's funny. I was trying to find an article about this exact topic, really just for statistics, because the thing that I always pull up when people say this is like, okay, well, tell me how you would have done in 2000 to 2010, right? And if you look at that period of time, there was a negative 0.95% annualized return for that 10-year period, right? And so I think part of investing is, one, like trying to avoid lost decades, right? Lost decades are something that can really hurt. If you just had the S&P 500 and that was the 10 years before retirement, right, that would really kill you. If you had a more diversified portfolio and included international, you would have had basically about a 4.5% to 5% return over that 10-year period of time, just by being diversified. And so for me, even if you looked at a 20-year period of time and you had this portfolio of international versus portfolio of just S&P 500 and you got to the exact same result, I would still much rather have the one that had international and I didn't do this massive drop where I'm like, oh my gosh, what do I do? Because, we can all sit here on Twitter and pretend that, like, oh, it doesn't really, it's not that hard. We all know to hold on to it, right? And it's easy to say that when you have $100,000, or maybe for some people $1 million. But if you have $10 million and you watch that go down by $3.5 million, I bet you're probably moving out. And I've worked with clients who in the last couple of years came in, they have 5 million, 7 million. They've been in cash for 2 years because they moved out of the market. And one, investing more according to their risk tolerance would have helped, but also just having somebody there to help show, here's what happened in history. Here's why this is okay. You're not in retirement, all of those really important points. But I think this all comes back to this asset allocation is really important because it helps you know the type of portfolio you want and helps you understand, is this a portfolio that fits my risk tolerance too?
Yeah. One thing I'll never forget, in 2009 was my very first year that I invested money. And I remember the advisor actually using the S&P 500 as an example. And it was a great piece of education that he gave me. Was he was showing me what the returns have been and like why we want to have a diversified portfolio. And it's so funny now, it feels like it's really come full circle. Like I'm the advisor, 15 years later, and I'm telling clients the same thing, but I'm flipping it and saying, here's why we don't want to have all of our eggs in this one basket, because like we don't know what's going to happen in the future. I just think it goes back to, like, the one thing I would encourage everybody is, like, just get educated around your options where you feel really comfortable around the money. Because, Thomas, you and I both know the inevitability of the market going down, like, it is going to happen. It's not a matter of when it's going to happen. It's not a matter of if it's going to happen, it's when it's going to happen. So we want to make sure that we're prepared for that on the upfront, and the emotional toll that it's going to take. Like for the clients we're working with, oftentimes that means the portfolio might be down millions of dollars. And we want to make sure that they are comfortable, they're educated, and they're going to stick with the plan, even when it doesn't feel great.
And I think you made a really important point there, just talking about bear and bull markets, right? I think people need to realize that it's a part of the investment game, right? Like, I think if you can take a step back and say, I know in the next 40 years of investing that I'm probably going to have 4 to 6 at least bear markets during that period of time. If we look back in history, this is how it worked, right? Average bull market lasts about 6.5 years. Average bear market lasts about 1.3 years, right? And so we know, hey, this is going to happen. It's going to come. We can't predict it. We're not moving out of it. This is what we're going to deal with. We're going to accept it. We're going to take advantage and invest through the ups. We're going to take advantage and buy at the lower prices of the downs. And then we're going to understand how our asset allocation is going to shift as we start to get closer from accumulation to decumulation phase. And this is where things get more complex, because I think the average person's like, great, I'm 5 years away from retirement. My asset allocation now needs to become 50-50 or something like that. But there's multiple buckets, right? So your asset allocation might completely shift, and you might have 3 to 4 years of a bond ladder right when you retire. So that way you can make sure you have enough income and you don't have to pull from your portfolio if it is down. And then you're going to have a midterm bucket. That might be 50-50, 60-40. And then you might have a long-term bucket that's 80-20, 90-10, et cetera. Because even if you're 55 and retiring, you still might need money in 40 years, right? You don't want everything to be super conservative.
Yeah. And I think as we wrap this up, I think that that's a really good thing for everybody listening to consider, is that this is not this stagnant process. Like you don't just come up with the asset allocation and you're like, I'm going to stick with this forever, which I think a lot of people make the mistake of. They look at whether it's a all equity portfolio or they're 80-20 and they're like, okay, well, if I get this return for the next 40 years, I'm going to tell you right now, like things are going to change in your life over the next 40 years. And that's okay. Just understand that this is something that you want to be looking at from a time to time and understanding like, hey, should I be tweaking the allocation? Because really what we're trying to do with any investment portfolio is it is fuel for your goals. So if your goals have changed, chances are like how you're investing this money, whether it's more aggressively, less aggressively, might need to be changed too. So guys, we really appreciate you listening. Thomas and I are putting a ton of effort to these podcasts and would love it if you would like and subscribe. I know these are up on Thomas's YouTube. We're also up on all the podcast platforms. Until next time, guys.